You want this recorded?
Yeah, please, we need it.
Okay.
Are we live yet?
Yeah.
Yes.
We are. Oh, okay. Welcome all. It's 4:01 East Coast time. I'm not sure where everyone's joining us from today, but we're all here. Glenn, Jill and myself are all East Coast, and we're excited to have all of you joining us today. We have about 25 registers today. We took some questions in already for this meeting. We're going to do this meeting a little different as we're starting off 2025, and we're getting a ton of questions from clients that are of similar nature. So we worked with Clark to put together an agenda of going through the top questions our advisors are asking at the beginning of 2025. Some of the main questions that we're going to hit today are, well, let's see. The number one question on the drawing board from Jeopardy is, how will markets do with Trump 2.0? The tariff question, everyone's worrying about tariffs. The other question that's out there is, last year we're coming off of the last 2 years with the market being very high. Is the stock market too high? And what's going to happen next? The other one, inflation, our economy, and the Federal Reserve. Everyone keeps talking about the Federal Reserve when you're watching TV. Government debt. I'm not sure if you've seen anything on TV about government debt, but that's out there as well. Bonds, the bond market. Bonds have actually been performing very well from a yield standpoint, but should we still stay in bonds? And what's the trajectory of bonds? And then the disclaimer bearing the lead here is, we're going to give it to you from an economic data today, historical data. We're not selling anything. We're not advertisers. So what I'm speaking about now is really the television screens that you guys are all watching, or ads that you're getting. Think behind the scenes of what they're selling. And our job here is to help you navigate your portfolios. As your fiduciaries, we watch your portfolios to make sure it fits with your plan. And we're there to make sure that you guys are calm and have good family life and not worrying about should you be buying gold or other things from all these different providers. So we're going to start at this meeting. Again, Glenn Dorsey, who many of you have met before, but Glenn is one of the senior people at Clark Capital in the portfolio management team. And Glenn's going to walk through some of these questions. So going all the way back, Glenn, how are we doing with Trump 2.0? What's going on in the world?
That's great questions. One that we get asked a lot. I'm going to run through a couple of slides here and show you, we're at kind of a historic point where it's been over 100 years since we've had a non-consecutive president in the executive branch. And kind of to your point, Adam, I'm not defending a person. I'm not defending a party. I'm not defending politics whatsoever. What I'm talking about is what the capital markets are what they're doing. So first off, when we're talking about tariffs, or you can't talk about Trump without talking about tariffs right now. Like they're intertwined. So during Trump's first administration in 2018, he started bumping up the tariffs against China, right? We had this big trade war everybody was talking about. And here are some of the headlines that we saw through 2018 and 2019. Tariffs going to imperil the global economic rebound, U.S. consumers losing $1.4 billion a month, tariffs about to trash the economy. It was the end of the world, right? Well, it wasn't really the end of the world. In fact, what we saw is during the Trump administration 1.0 from November 2016 to November of 20, the markets did pretty well. The S&P 500 was up 70% on a total return basis over that time period. We obviously had a period during COVID where the markets, struggled. But keep in mind, when the tariffs kicked in, it was the middle of 2018. So it's kind of, back here. And then up until COVID, what happened? The market was going up. during all these tariffs and the end of the world that the media was portraying. And they're doing the same thing again right now. And this is a little dated because everything has to go through compliance. But if we updated this through yesterday, you'd see actually all of the indices are up here. The bond market's up, the S&P's up, small caps, which is the Russell 2000, is up. And guess what's up also is international. International is actually outperforming the US, which everybody was convinced with tariffs, the international is going to be horrible. So, there's been a lot of executive orders. We can't keep the blue bar all the way to the right updated fast enough because we're having a lot of executive orders happen. But they're not new. Everybody did them. FDR, was pretty prolific at it. In fact, a little point of history is FDR passed what was called the Reciprocal Tariff Act back in 1934. So he signed a lot of executive orders, and in fact, he was actually trying to lower tariffs, but what they wanted to do is keep them the same as what countries were charging us, which is what Trump's reciprocal tariffs are all about. There's a lot gets said, in politics, and then, it's kind of what they say to get elected. What do they actually want and care about? And then what can actually get passed? And there's a big division amongst all of that. Some of the things that Trump had talked about, possibly lowering the corporate tax rate to 15%. Part of that theoretically could be funded by tariff revenue. So that's part of that package. Some other write-offs for corporations, to encourage capital investment. Most people really aren't talking too much about that right now. For the individuals, I haven't heard this one recently, but they were talking about eliminating tax on Social Security benefits and tips. Hear about that one still fair amount. And then, what has become more likely is the Tax Cut and Jobs Act, lower tax rates are more likely to get extended now. And then, again, it kind of brings us sort of into the tariff question, which you kind of, like I said, they're sort of intertwined with Trump. Again, walk you through a little bit of history of this. So the first tariff was put in place on the 68th day of George Washington's presidency, and we've had tariffs ever since. They never have gone, they've never gone away, right? And to put it in perspective, I've heard some people talk about, here's a history of what the tariffs have been in the U.S. So the red line is what percentage, or purple line, whatever color that is, what percentage of imported goods are actually being levied a tariff on them, or duty. And then the blue line is the rate on those goods that are being imported. So all throughout these, and everybody talks about the it's actually Hawley, not Harley, Smoot-Hawley tariff, causing the depression, and that's not really that accurate. But prior to that was the Ford-Macomber tariff, which was back in 1922, where that was an aggressive move by the U.S. to raise tariffs. And the average tariff on that point on goods was somewhere in the 40% range. So it was pretty significant. And then the Smoot-Hawley tariff came back through in 1930 and kind of raised the number of goods that were getting tariffed. But when you kind of compare that to where we are now, at the highest point of the tariffs back then, the 59% tariffs on the goods that were being tariffed, or put a duty charge of 59%. Now, where we are as of right now on the goods across the globe that we're putting duties on, it's actually 3% of imports. So it's a very, very different picture, and the media, just loves to get everybody all excited about this stuff. But we've been in a trade battle with China since the middle of 2018. I think it should be pointed out that those tariffs never went down under the Biden administration. They just let them ride, basically. And as a matter of fact, a few things were actually increased along the way. But you can see those two up top, what China charges us, what we charge China, up in that 20%. But again, it's not on all goods either. It's just on some. And then kind of look at where everything is versus the rest of the world. And they're way, way lower. So when you're talking about these reciprocal tariffs going into place, we very well may be putting in, a 1 or 2% tariff on some countries that have a 1 or 2% tariff on us. So it's, not as bad as you think. And really what we saw during that time period where these tariffs were being put in place and everybody says they're inflationary, and that, just at face value, that makes sense, right? If companies are getting charged a tariff, they're going to pass it along. But when you kind of really break out, what goods are subject to tariffs, we did see those prices go up. That's that blue line here. We saw this is the personal consumption expenditures on goods that were subject to tariffs. The prices went up, but about 2/3 of the goods that we bring in aren't subject to tariffs, right? And the prices on that, everything else went down. So that when you took a look at the net effect of all of these tariffs that went into place back then, and they're still in place, we actually saw the consumer price index go down over that time period, right up until right before COVID, and then obviously a lot of other stuff happened that wasn't not related to tariffs. And the S&P 500 from mid-summer 2018, July 1st to February 2020, right before COVID kicked in, the S&P was up 25%. Right. So as you're hearing, you need to buy gold because of the tariffs, and you need to stock up on water and guns because of the tariffs. That's not what played out in history. And we have a pretty recent history going on right now. So, I think it's really, really important to keep these things in perspective. I think not enough people look at history, and it doesn't always repeat itself, but it often rhymes, as they say. I'm blurry. Let me see if I can get my, there we go. Thought I was gonna pass out or something.
You were fading out. All of a sudden, your tariffs making everyone blurry. So it's okay. But really, there's been a lot of talk and a lot of noise about tariffs. We've been talking about it, but the portfolios are actively managed, and a big theme of tariffs that have been discussed with us and with multiple firms is you really won't know what the end result of tariffs will be until they're in and you see a couple of quarters happening. And hence the reason why you're looking back at history, right, Glenn, and saying, well, when these happened before, this is what ended up happening. And your chart there that just said, these tariffs that went in during Trump 2.1 or 1.0, now they stayed in place during the Biden administration, and just recent memory, markets went up anyway with them in place.
The markets went up under both Trump and Biden, and the main reason for that is companies' earnings went up. So when you start to pick winners and losers, we look at the tariff thing, and the assumption is made in the media that it just crushes the whole market, and that's clearly not the case. When you actively manage the portfolio, you can start to decide who's going to be a winner and loser once you know what the rules are. And we've seen, Colombia had a 25% tariff put on and taken off within a 24-hour period of time. So if you reacted and managed your portfolio and reacted to every single news item, Canada and Mexico were going to have 25% tariffs. They got kicked down the road a month while they negotiate, and maybe we don't end up with any. So if you react to every single news item, you're gonna end up being a loser. You're not gonna hit your financial goals. What we do know is that the tariffs are only on goods, not on services, right? So right off the bat, it becomes pretty easy to start to see winners and losers. Like if you're think about all the financial services industries, we don't import goods, right? So they're kind of immune to the tariff struggle. And then you can get the specific at what industries are really trying to be protected. And that's kind of what a lot of this ends up being about. I think with Mexico, Canada, and China, a lot of it is really, as they say, it's kind of help on the border for various things. Well, not the least of which is fentanyl. I just saw that the Mexican government, they made a sting operation. They recovered 4 tons of methamphetamines. Think that's a part of their negotiation with Trump. Is like, hey, we just found 4 tons. I wouldn't be surprised if the cartel gave them the 4 tons and said, let's get this done and over with, and now we can all go about our business. But we don't know what's going to be in place. Once we do see what the final things are, it will be pretty easy to see who winners and losers are. And you can kind of tilt a little bit and find something that's going to be okay in either environment. You know, that, and that's to your point, that's active management.
So with that, with active management, and again, for everyone that's on the call, in the Q&A part on the bottom, we do have our set questions, but we can pivot. So if there's a follow-up question that any of you have, please put it into the Q&A and we'll get to it. Follow-up to that with active management rolling into 2025 is, okay, markets did really, really well in 2023. Then markets did really, really well in 2024. And the markets are projected to do well this year, maybe not as well as the last 2 years, just based on all the different portfolio managers, including Clark, with the projections of where the S&P 500 should be in the trajectory of the markets. But are the stocks just at too high of a level right now that they can't go up from here?
So I'll give you the there's a lot of different ways to answer that. I'll have a couple of slides I could probably show too, but I'll speak to it first. Is that what the market did the prior year has very little bearing on what the market does the next year. Right? The fact that the market had 2 good years in a row does not mean that you can't have a third good year in a row if the conditions are still in place. And one of the things that I've said is that this period reminds me a lot of the mid to late 90s. Right, where we had a tech revolution happen. All companies, I mean, the tech companies did really well. The stocks went crazy, great. But every company benefited because productivity went through the roof, right? So you saw 5 years in a row that the market was up 20% or more per year. 5 years in a row. 2 of the years it was up over 30%. AI is very similar in the sense that some of the tech stocks are going crazy, great, that's wonderful. But every company is going to benefit from this. You know, there's a million different applications for AI that don't even necessarily, you know, replace people with robots, but it can do some tedious things and get it off your plate and make everybody be able to focus on their highest and best use. So as this market is hitting all-time highs, we just hit an all-time high on the S&P 500 yesterday, and looks like we did again today. So that's the third new high this year. We had 57 new highs last year. But when you kind of go through it, here's kind of, you know, a chart of what the market looks like. The purple line is the daily close. So there's a lot of volatility. So what we like to do is smooth it out and see what the trend is. So the orange line is a 50-day kind of moving average, and the blue line is a 200-day moving average. We're in a solid uptrend right now. But when you look at it, you think of the most logical thing in the world, and is that, you know, if a company makes more money, it's going to go up in value, whether it's your own company or whether it's a stock of a company. And companies that make less money will go down in value over time. So when you go back, this is a 25-year history of the S&P 500 earnings and the S&P 500 price. You don't need a PhD in math to see that there's a very strong relation. When earnings are going up, the prices are going up. Now, it's obviously not every day. You get a lot of volatility along the way. But as the market's hitting new highs, we just are posting our third consecutive quarter of record high earnings for the S&P 500. Right? Earnings are at an all-time high. At the same time, stocks are at an all-time high. And, you know, I think we should reinforce, to your point, Adam, you know, 23 and 24 were really good years. And we've had a lot of really good years in the past, but what made those 2 years unusual, this is a look back to 1963 forward, basically, in terms of what the market did. And the blue bar is kind of the high and low for the year. And the red line, little dash here, is where it closed. What made this an exceptional period is that we were almost never down last year. We were almost never in negative territory. Most years, you know, you're challenged and you'll say, oh, I'm lower than my year-end statement. We really didn't have much of that, you know, a little bit. So we were calling them unicorn years. They were 20% plus returns without really being challenged by negativity. And, you know, I think we tend to think that we're always in the craziest, most volatile times. And if you actually look at the data, the last couple of years have been less volatile than normal, right? By a whole bunch of different measures. In fact, it shows that the blue bars are the number of days that the market was down 1% or more. And the average is about 31 over time. And both 23 and 24, we had lower than that. So most of the days that the market moved 1% or more, they were actually up. So we've had a kind of a really nice time period. But when we experience that, as I say, being an equity investor is like flying on a plane. If you fly from Newark to LA, most times you're going to have turbulence, right? It's going to be okay, but you're going to get bounced around some. And that's how it is in the stock market as well. The last 2 years have been the equivalent of flying from Newark to LA with no turbulence. And enjoy it, but that's really not what you should expect. You should expect a little more volatility. In a normal year, an average year, you get 3 pullbacks of 5% or more. That's just kind of average market volatility. In fact, you get a 10% correction about once a year. Over the last 2.25 years, we've had 3 5% pullbacks and 1 10% correction. So far lower than normal volatility. When we see the volatility like that, we're usually happy, right? Because if our companies are making the same amount of money or more, and their stock prices go down by 5, 10, or 15%, now I can buy the same business for cheaper, right? That's a sale. If you're a retail land, that's fantastic. People get scared and emotional with their money, which I get it. I mean, we have money in the market too. But you have to remember that what we're really buying is the underlying business that's represented by the stock price. That volatility, as long as this is in good shape, this is the calendar year earnings for the S&P. The blue is actual, and the I don't know. They've picked the strangest colors: gold, bronze, pewter. Are the estimates for 24, 25, and 26, because we're still not done the fourth quarter earnings reporting season. If our companies are making more money every year, it's reasonable to expect that over time that the stock prices are going to follow that. So, that's kind of, you can't just look at the market and say, we're at a new high, it's got to go down. As long as the fundamentals are still in place, that's okay. And when we look at, the only other component into the level of the market is how much money does the company make, and then what are people willing to pay for that, right? And we can chart that and say, well, here this is a look at that. So it's price and divided by earnings. So if you're going to buy a business in town, and if the store made 100,000 and you paid $1 million to buy it, million's the price, you're 10 times earnings, right? By historical measures, when you look at that, you can say the S&P 500 is not cheap. And part of it, a big part of it, is the green line here is the mega cap 8s, the Googles and the Metas and Microsoft, Nvidias, all of what used to be the FANG stocks, and then the Magnificent Seven. Now it's the Mega 8. They're trading at much higher levels than the rest of the market. In fact, when you pull those out, you can take a look at the market without those 8 companies, actually kind of cheapish relative to history, or at least fair value relative to history. And the difference between now and the 90s, when you talk about tech stocks, is these companies are powerhouse companies. They have real businesses. They generate a ton of profits and cash flow. That's all pretty good stuff. So when you think about the growth rates of the market and then compare it to what you're paying, which is what this chart does, all of a sudden you realize that, for how quickly the earnings are growing, or how strongly the earnings are growing, we're really not paying that high of a multiple for that growth by historical measures. In fact, one could argue that it's kind of pretty basic in terms of where the values are. And realistically, it just kind of makes sense. As I say, if you're looking at 2 identical houses, and one's in a market that everything is great, the school system's fantastic, everybody keeps their house in good repair, and property values are appreciating 15, 20% a year, and you have that identical house in a market where everything's kind of not so great, and the property values are going up 1% a year. If you had to make an offer on those 2 houses, would you be willing to pay more for the one in the good neighborhood that's going up in price? Of course you would. So that's what you start to have to think about the S&P 500, and specifically the mega cap 8 type stocks. They're growing their earnings at a pretty rapid clip. they probably should trade at a decent multiple.
So, you know, and just kind of piggybacking on your idea, and this is how I've summarized it with some clients, and Jill's heard this, is more along the line of, you know, reversion to the mean as far as volatility in the marketplace. Going back to your turbulence, people may not want to be talking about the airlines right now.
I know. I thought of that.
So,
Yeah.
but there is, you know, I know majority of the people on this call right now are in the Northeast, and I'm in Florida, and Jill's in Florida right now. I'll be back in the Northeast, but I have the pleasure of being in 73-degree weather today, and the Northeast does not. But that's normal, right? We've
Right.
had abnormally abnormal winters the last couple of years. We haven't had snow in a while. That's come back to be normal. So
Right.
these things do happen in cycles. So, all right, so we've had positive cycles in the marketplace. Volatility may have been under weighted over the last 2 years, which is great. Everyone likes that. Obviously, we have the talking heads on TV, no matter what. It was interesting last year. My observation from last year is, you know, anytime the market went down, which was only twice last year of 5%, the sky was falling. But all those positive days, we weren't hearing on our talking boxes all how positive things were. It was all about the election and how bad things were going to get. And no matter what, it was always selling the bad. But going forward, we have this economy now, and other things that we're seeing about the economy is, oh, the economy is about to fall off the cliff. The economy has a problem. And the Fed's going to start raising rates again, and inflation's out of control. Are those things really what we're seeing in with the data points?
No. So
Okay.
you always have to, I always say, if you figure out people's motives, you can figure out what they're going to do. The motive of the television programs is to get you to watch more so that they can charge higher advertising rates. If you turned on your television and you heard them say on CNBC or Bloomberg, like, you know what, everything's pretty good, you know, you'd say, oh, cool. And you turn it off and you would go do something productive. But no, they're going to say, you know, breaking news, the Trump tariffs are going to kick in on April 1st, and it's going to cause a global economic slide. And this, you know, we're describing the economy right now as, you know, it's Goldilocks. It's not growing so fast that inflation is likely to come back, nor is it slowing down as it typically would in an economic cycle, that the Federal Reserve has to cut rates really aggressively to stimulate it to avoid a recession. So, you know, here's a look at the economy. It's been cooking along at a pretty good pace. Somebody's like, you know, think about 3 years ago, everybody was calling for a recession. And yeah, some CEO that's very famous said there was going to be an economic tsunami coming. And we didn't agree with that because when you really think about what drives the economy, it's the US consumer. And what we have found to be true, and I know it's true in my own life, is that when we American consumers have jobs and are making money, we are spending it. We're really exceptionally talented at doing that. So when you keep, you know, the U.S. consumer 70% of the economy. So if you keep a close eye on the labor market, how's the job market doing? Well, it's doing pretty well. You know, we had unemployment actually tick down to 4% last month. We had two months in a row where we had over 200,000 jobs created. Last month was a little bit lower. But you know, people point to the job openings rate and say, well, there's less job openings now. Yeah, one of the reasons that a job opening goes away is because you filled the position, right? So, you know, just looking at that in a vacuum is very sensationalist. And what is interesting is in all of this data that nobody bothers to look at, if you actually dig through the report, you can see the number of people that were actually laid off, right? That's when things are bad. You can leave your job voluntarily because you're retiring or you got another job that has has better pay or whatever. But then there's the involuntary, which is layoffs and discharges. That that level has stayed remarkably flat at roughly 1.1% of the labor force. It really, we have not seen a big pickup. Now, again, the media is going to find every single company that has a layoff and be all over the news with it. But the reality is that in aggregate, it's pretty solid. And I'll just add on to that too, because we've been asked this a couple of times. Oh, what about all the federal workers that are being laid off? There are 75,000 people took the early buyout, and there's another 10, I think, that got fired. So it's 85,000 people. The total labor force is 170 million. So that comes out to 0.45% of the labor force was just lost their job. And who says that they're not going to get another job, right? They very well may go take their buyout package and get another job somewhere else. So it's not, they may not even leave the labor force. So, from our vantage point, the labor markets look good. Companies are going to be very reluctant to do mass layoffs because the number one challenge that companies face is finding workers. That was the case before COVID, and it was the extreme case after that. So companies are really going to hoard employees, and that's what they've been doing. And consequently, if you want to, here's the retail sales. This is what consumers are spending. Why? Because they have jobs. They're making more money. They're spending, and that's a pretty solid figure. Inflation is one of those, it's all kind of ties together with the Fed. The Fed has two goals. One is to keep inflation in check, and the other is to keep people working, right? That's the only two things they're responsible for. People are clearly working. We saw a giant spike up in inflation, kind of mostly as a result of COVID, partially as a result of some bad government policy, which is giving people a lot of money to spend when we can't make anything. That's gonna actually is almost the definition of inflation right there. But the price increases are coming down. Now, again, that doesn't mean prices are coming down. They're not going up as fast as they were. That's what inflation measures. And it's kind of funny. I'm putting together a presentation for a market update I'm doing in a couple of weeks. And you can kind of look at what some of the items are. Everybody knows the egg prices are through the roof. Red meat, chicken's up a lot. Bananas are flat over the last 20 years. So the moral of the story is eat more bananas, and you'll avoid the inflation at the grocery store that we all see. But the Fed's trying to get down to this magic 2% level. They haven't been able to get there yet. But what we see is that if you think about also when you're talking about tariffs and inflation, they start to think about what goes in the consumer price index. And I did this because I like to look at information, but there's about 200 items that go into the consumer price index, and they basically reprice that every month, right? So a couple of things jumped out at me. I went down the list to say, okay, well, how much of this is really going to be affected by tariffs? The biggest contributors to the consumer price index are shelter, right? Our cost of housing, that's the biggest component in there. That's not subject to tariffs. Then you get into, insurance and medical and car insurance. A lot of that is not subject to tariffs at all. In fact, when I kind of went through it, and this wasn't super scientific, I came up with something like 13% of the CPI looked like it could be subject to tariffs. But one of the things that we're seeing is that there's a lag effect in the consumer price index with the cost of housing, because new rents that are being signed are actually those levels are coming down pretty quickly. And when we again go back to what the Fed's responsible for, it's two things. It's inflation, which is here, and unemployment, right? When inflation was higher than unemployment, the Fed was raising rates. Now we're at this point where they're starting to lower rates, and they're doing it, slowly, thoughtfully, because they have that luxury of doing that. The economy's, arguably in pretty good shape. They're in an unusual position because typically at this point of a cycle, the economy's falling apart, and the Fed's cutting rates very rapidly. And what we see is they're going about it pretty slowly. Here's the Fed funds rate. We were up to 5.25% at the right before the September meeting. They lowered 3 meetings in a row by about 1%, so that brings it down to 4.25%. But they're starting to slow down now. and again, people say, oh, well, we're not going to get 5 cuts or 6 cuts. That's going to be horrible for the market. But if you go back and look historically, when the Fed is cutting rates, the market does well when the Fed's cutting rates. Average a year after the first cut's 14.5%. But when they're doing it slowly, the return's 24% a year out versus when they're doing it quickly when the return's only 5%. So we're up about 8 or 9% now from the first cut in September, which would tell you there's still some more running room there. And when you get to the why would the market do better when the Fed is cutting slowly? Well, the only reason the Fed cuts quickly is because the economy is falling off a cliff, right? Clearly, that's not what their assessment is. That's not what our assessment is. And they're, I'm not going to say that they're doing a great job with it, but they're in a position where the economy is kind of self-sustaining and doesn't not need a lot of support. They've literally just taken their foot eased off the brake pedal a little bit.
So a question came in, or it was more of a statement that came in. But it's a valid statement just because of what we're talking about. You're going past back data, and we're still seeing the economy working based on the old administration. Now we have a new administration. How soon do you start seeing the impact of the changes that are happening now administratively? Is it a 6-month lag? Is it a 12-month lag? Where's when you're looking at the projections, and I know you've already kind of answered the question in one way of showing where the tariffs came into play and how that impacted the market and how the market was up during Trump 1.0. Then we had COVID, and then during the Biden administration, pumped a lot of money into the economy, caused inflation to go through, but the market went up. Now we have 2.0. And the markets are still behaving positively. How long is it that administrative changes then? What's the tipping point, I guess?
So a lot of those concerns, I think, are more based in whether you like the politics or not, or the person or not. We have an expression here is that stocks don't see red or blue, they see green. So it all comes down to earnings. So if you look at the policies that may or may not get implemented and start to think about, well, what are the effects of those going to be on earnings, right? Tariffs could affect some companies, but overall at the market level, probably not that big of a deal. Even international companies, generally speaking, have manufacturing facilities in the US, so they can make the stuff here and not pay a tariff, right? Which is part of what they're thinking about. Layoffs at the federal government level, zero impact on corporate earnings, right? If they cut corporate taxes, that would be a positive. You could get into the political third rail. What would changes in immigration policy do? There would be some industries that would be likely to have higher wage costs, right? But not everywhere, right? So again, this is the difference between owning the market and owning a market of companies or market of stocks, is that you can be selective in what you own and position yourself for the best chance of success for what those things are. When we look at what the policy agenda items are, again, taking aside, I'm not defending a person or a party or anything, is that when we look at them, most of the policies are pro-business / earnings, right? That may not be good for the deficit, perhaps. But from a stock market standpoint and an earnings standpoint, it's arguably a little bit of a tailwind with less regulation and potentially lower tax rates. That would be a positive for earnings.
Got it. Well, you just started talking about this, so we might as well roll into it, which is it kind of goes into the government debt. That's a concern. That's a negative piece. That's concerning all. When if you look at your home balance sheet and you're bringing home less money than your expenses are, you're in the red, and families don't deal with that well. They have having credit card debt. and they start to choke. And then they hopefully ask a family member to bail them out, or they claim bankruptcy. Well, US government debt kind of in that scenario right now. So that's a problem. How does that impact us?
Yeah, that's a great question because I just celebrated my 40th year in the business last month. And from the time I got in, the world was coming to an end because of the twin towers of debt, which was our outstanding government debt and the trade deficit that we had at that time with Japan was the big culprit. And here we are, and I'm 40 years older, and the market's a heck of a lot higher than it was before. Um, the dollar hasn't collapsed like everybody said it was going to, and interest rates haven't gone through the roof. In fact, we went back and looked. This goes back to 1960. It goes back to 1966, and so you have to look at that outstanding debt as a percentage of the economy. Now, again, we're not condoning deficit spending. None of you that are on the call are deficit spenders because you wouldn't have amassed any net worth, right? The government is a little different because they are able to print money when we normal humans can't. So when you look at the debt level of the government as a percentage of the economy, in 1966, it was 40%. It actually went down to 33% in the early 80s. And now we're at 120%. So it's basically quadrupled from the lows, and it's up 3 times from 1966. So you say, oh my gosh, world must have come to an end because the debt level tripled. So interest rates during the time period when the debt levels were going down actually went up. And then when the debt levels started going higher, the interest rates actually came down until 2022, and they went up because of other factors, right? So interest rates acted the opposite way of what they're telling you on TV. Well, what did the stock market do from 1966 to now? Well, the S&P 500 was at 90, and now it's at 60, almost 6,200. Sorry, it's hard to write with a mouse. My handwriting is not that good to begin with, but it's even harder when you do it with a mouse. So clearly it didn't affect the stock market. And if you looked at a chart of the dollar, it's more or less flat. And in fact, the yield on the 10-year treasury in 1966 was 4.5%, which is right where it is right now. And they would have you believe on TV that we're going to have interest rates like we're a underdeveloped country somewhere in the middle of nowhere, and rates are going to be 30%. And it's just hasn't played out. Right? Yes, history isn't always going to be the same. There is some sort of a tipping point at some point, but we're not. It's still far out. What is the current administration doing in that regard? The new Treasury Secretary, his goal is to bring down the deficit per year, which is about 6% of the economy, down to 3%. That's his goal. That's a great goal. Do they get there? Hard to say. There's not a lot of discretionary spending in the budget. Right? Most of it is fixed costs in terms of Social Security and interest on our outstanding debt, all of those things. Then you have the whole Doge initiative. I think whether you're a Republican or Democrat or like Trump or Musk or whatever, I think everybody could probably agree that the government's not that efficient, right? So there's probably some waste that can be cut out of that. Is it enough to make a huge difference? Probably not, but it is better. It's a step in the right direction in terms of, and again, I'm not condoning anybody or any way that they're doing it, but I think everybody would like to see less of a deficit. That I think everybody would agree that's a good thing. And I think that what you need to think, we need to watch this. I think where we need to react the most to all of this is when we vote versus managing the portfolios, because as long as it doesn't impede companies from making money, which it hasn't, the stock market should follow the earnings. And ultimately, if you get to a point where for some reason that does impact earnings, that's a different story.
What about, so we talked about the stock market and that drives it, but the bond market's 3 times the size of the stock market, but no one talks about it. And we, over the last couple of years, recognized that interest rates were going up, and so we were able to lock in higher interest rates for yields for our clients with the guaranteed yields that are in there. Now with the interest rates where they're at, they've started to come down a little bit, but kind of pause right now. Where are we with the bond market? What's the play in the bond market right now? And obviously the Fed is one of the factors of this.
So, in general, bonds are supposed to be boring, and they were not boring in 2022 in a bad way. They were horrible because rates went up through the roof. There were some unusual factors. So we're kind of moving back to bonds being a little bit boring, but boring is good sometimes. So what we like to look at is we'll look at what's called the yield curve. We'll look at what's the yield on a 1-month treasury bill, a 2-month, 3-year, all the way out to 30 years. And then you kind of connect the dots, right? That's when you hear people talk about the yield curve, and particularly what they were talking about was the inverted yield curve, because short-term interest rates were higher than long-term interest rates at the end of 2023 or the beginning of 24, right? So we had that in what's called an inverted yield curve. What's interesting is that as the Federal Reserve started to cut interest rates, we saw short rates come down a lot, which makes sense because the federal funds rate is overnight lending between banks. Doesn't get much more short term than that, other than the loan shark on the street, right? This is very short term. So the short rates tend to follow Fed policy. Longer rates tend to follow inflation outlook and economic outlook. So what we saw is short rates came down and long-term rates actually went up. And this is as of the end of last year, but it's still it's the same picture today. So what does all that mean is that, one, it was very popular to park a lot of money in CDs and T-bills because you had a higher return and it's pretty safe. The problem is now as they mature, you're not going to get that same rate. It's going to be lower. And the more the Federal Reserve lowers rates, the lower that gets. It's time to really start to think about locking in those higher yields that are available for these longer, a little bit longer term. You don't want to go far out because they're too sensitive to rates. But keep in mind, when you own an individual bond, the second you buy the bond, you have locked in the return of that bond. The price might do this along the way, but every single bond comes with cash flow along the way, which comes in the form of interest payments, right? It's stated right on the bond. It'll say, we're going to pay you 5% a year until 2035 when this bond matures. You can calculate and then you get par value back when it matures, right? Assuming the issuer doesn't default. All of that's known the second we buy the bond. We know what we paid, we know what the interest payments we're going to get are, and we know what we get at the back end when it matures. So it's a lot like if you signed a lease to rent out a piece of property. Your rent's locked in until the lease is over. And as long as your tenant doesn't, not pay you, you know what you're going to make on that, right? And it's the same with an individual bond. So the difference where we are now is that, longer term interest rates are pretty high by historical measures. And this is a little complicated, but bond prices generally, they go up when interest rates go down because you've already have all your cash flow locked in, right, when you buy the bond. So if the rates go down, you're looking pretty good, right? So the price of those bonds go up. So this takes a look at a whole bunch of different things: a 2-year treasury, a 5-year treasury, investment grade corporate bonds, which is primarily where we play. We're in the high yield bonds, where it could be investment grade bonds, we can be in municipal bonds. All of these blue bars show you what theoretically the price would do if interest rates went down by 1%. So all pretty good. And then conversely, if interest rates go up, bond prices go down. But what you start to see is the up is way better than the potential down. Now, nowhere in our forecast do we think rates are going up by 1%, just to get that out on the table. In fact, we think they're flat to down. So we should be collecting our coupon and getting a little bump up along the way in prices. So bonds are actually, kind of looking pretty good. Last year was a year where this is the 10-year treasury yield, the rates went up. The 10-year treasury started at 3.88% and it ended at 4.58%. So rates went up, bond prices went should go down. But what we saw was that across the bond spectrum, you had a positive return. Why? Because there's little bags of money on the seesaw. Well, the interest payments were enough to offset that decline in price. We have a lot of money that we can lock in terms of coupon now by historical measures are actually at pretty good levels.
Got it. Well, we had a question that came in that was sort of answered, but we're just going to double click on it. And this really goes back to economic data about immigration. So you started talking about it a little bit, but didn't go deeper. Could you go a step deeper on the immigration question? If all of a sudden we have all these deportations, will that negatively affect the economy? And I know you already mentioned that in certain service industries or certain industries, the cost of labor may go up a little bit, which will then get passed on to the consumer. But can you expand upon that?
Yes, it's a great question. And quite frankly, I don't know if anybody really knows the data on what the immigration situation is. So let's take it we'll take it apart a little bit. Let's assume nobody new comes in over the border or from any border, legally, illegally. The potential growth of an economy is tied to the growth of its labor force times productivity gains. Now, again, we think we're going to get a lot of productivity gains out of AI. But if you have your labor force not growing as quickly, that should theoretically dampen the growth of the economy. It doesn't mean you go into a recession. It means it dampens the growth potential of the economy. So that's one element of it. If the deportation stops shy of deporting everybody that's ever come into the country undocumented, which is, I think, a fairly good guess that that's where this ends up. And they're obviously starting with people with criminal records now. That's I don't think that's not gonna affect the economy or the labor market in and of itself. If it starts to go much deeper than that, which I suspect there'll be some sort of a bargaining thing that's accomplished before we get to that level. I don't envision a scenario where they're going, pulling people out that have lived in the country for 20 years and had jobs and raised families and paid taxes and all that stuff. I don't see that level of deportation happening. I think it's, that falls into one of those things that might very be popular to say, but probably not likely to get fully enacted. If it was to happen, certain industries would be hurt more. But even with that, you look at, you would think one of the areas that they talk about the most is, the migrant farm workers that often come in. But labor as a percentage of food costs is about 13%. Right. So it's kind of shocking when you really start to, let's get all the emotion out of the way and how you feel about all of that stuff and start to look at what do the numbers really look like. There would be adjustments for sure in the economy, but I don't think it's as catastrophic as it would appear at face value. Again, I'm just purely speaking economics. I'm not minimizing, impact on people with this, but.
Sure. Yeah, again, at the end of the day, Glenn, when our clients are working with us, and when I say us, I mean collectively with Forefront, all our partner firms, we're here to steer the ship and try to take the emotion out of it, because we want our clients' portfolios to grow. We want to make sure that the portfolios are there to sustain the lifestyle of our clients. And we work with wealthy people. I mean, at the end of the day, our clients have wealth, have saved money, and have built their wealth. We all have opinions, political leanings, philosophical, emotional, spiritual opinions on things. So those come in and out. What we try to do when we work with clients, and why we like working with Clark as well, is we try to strip out those conversations and really get down to the raw data. Where does it impact the companies or that we're taking your money and investing in, and we want to be investing your dollars into places where the markets are going up, the growth of those companies are going up, the yields of those bonds are going up, and minimize when those companies are going down, and having active management during times of administration changes and during times of turbulence in marketplaces. We have the ability to surgically remove companies that are going to be negatively impacted on administration changes, on tax law changes, on tariff changes, on immigration changes. So we're here to custodian the portfolio. It may be too early to tell where things are going to occur. So I know immigration it's a third rail. It's a sad piece, and no one wants to see families impacted negatively. Good people in this country that are trying to live the American dream. So we all can probably rally around. We want good people to be in our country, to add value to our country all the time, and add value to our portfolios.
Yeah, as I said, 40 years in the business. I started with Ronald Reagan as president, and I've gone through, Democratic presidents, Republican presidents, and what I recall about each one is that when there was a change, there was a group of people that didn't want that person in office that said the world was going to end, right? And that hasn't changed one bit. So again, every time you hear an item on TV, an agenda item, strip aside your emotion about it and whatever your philosophical beliefs are. Just say, is that going to impede XYZ company from making money? And the answer is more likely than not going to be no. And if that's the answer, which is what our job is to figure that out, then any volatility in the market's going to be relatively short run, and the stock prices are going to follow those earnings higher. Right? That's what we get paid to do. I've had different presentations, a collection of all the headlines, not all the headlines, a bunch of headlines that I've seen over the years, and I've never seen a time where I looked at the paper and said, "Wow, everything's fantastic. This is great." Like, it's always bad news, right? Even look at, there's been some really bad weather events too, so maybe it's not a good analogy, but now when it snows, back to what a normal winter looks like, it's a polar vortex or an Arctic bomb or a atmospheric river, or how about it's just snowing and it's cold because it's winter? Like, everything's dramatic, and it doesn't need to be.
Absolutely.
So the takeaway is we should all stop watching TV. That's really what the takeaway is.
You will end up with better investment results, and you will have a better sleep pattern, and you will be generally a happier person if you consume less media. And that comes in all forms these days.
It does. Jill, any other questions that are coming in that you've seen, or any follow-up questions that you have?
So I wrote down some, I saw some from the chat, and they've all been answered. So what I would say to everyone who is on the call, if anything comes up and you think about something after you drop off this webinar, reach out to Adam and myself. Glenn and Clark are an extension of our team. So whether we need to get them back on or not, their team is available. We're here to answer any questions or concerns that come up. But as of right now, the answer is no. There's nothing else pending.
Well, so then we're going to end today's call. We're going to have this call has been recorded. We'll post it on our website after it goes through compliance. And we also have to make sure that when we speak, we're staying within a compliance world. We know when we have individual conversations with each of you, we can be more specific. This was a general discussion just on economic data. You are all very valuable people to us. We honor your trust in our guidance and our planning and our services, and we love working with our clients. We have all these CEOs. Each one of you that are on this call are one of our CEOs that we answer to. We care about your families. Glenn's putting up all the descriptions of making sure that we're carrying our compliance and check marks, so the lawyers who are always our friends are happy. And I'm saying that facetiously. But with that, we're gonna end the call and we'll let you know when this should be up on our website within about a week as it goes through compliance. So thank you all. Have a great day. Stay warm if you're in the cold, or stay cool if you're not. Be well.
Bye.
Take care.